For our next speaker, I'll turn to English again, because he will be presenting in English. The war in Ukraine, has made us wonder what exactly is responsible in investing. If we send weapons to Ukraine to help a country defend itself, is investing in weapons okay as well? Investing in Russia now is frowned upon, it's even sanctioned, but do we have to look at other countries that might have the same kind of ideas? Do we have to divest in those countries as well? These issues are addressed by John Ploeg. I'll pronounce it in Dutch. Welcome, John Ploeg. And he's from PGIM.
Thank you.
Well, you have a Dutch last name.
I do.
But the connection is way back.
Unfortunately, it's too far back for me to speak Dutch. Sorry about that. It will be in English.
Okay.
I will stand here.
Yeah, wherever you want. Yes.
All right. Hello, everyone. Thank you for coming. Thank you for having me. So I think the key message that I want everyone to take away from this, and which you've probably already heard at least once today, is that ESG is complicated. There aren't easy answers. There isn't some black and white rule that you can use to determine what is good and bad ESG. And the war in Ukraine is a really good example of this, and it's making us learn a lot of things that we didn't already know as well as reinforcing things we already did. So I'm going to start by looking at Russia itself really quickly. I think from an ESG perspective, that one's a pretty easy question. If you're looking at ESG from an impact lens, from a risk lens, no matter which way you're looking at it, you would probably say right now that ESG is bad in Russia. So we share that view. That said, you can see longer term, there's going to be some questions. The current account surplus is as high as it's ever been, for instance. And at some point, hopefully, this war will end. And we're going to have to decide at some point, what are we going to do when that happens? You know, if you look at conflicts in the past, at some point they end. And at some point, you have to ask yourself, do we continue to stay out of this country? Or have they remediated whatever the problems were? And so right now, it's pretty clear what to do. But we'll see what the answer is in 10 years from now. So already it's getting a little bit complicated. But then we see a lot of interest also, not just in Russia, the country itself, but also in companies in Russia. And this is where it starts to get a little bit more interesting. So the knee-jerk reaction would be to say, we should kind of ring-fence all the countries that are in Russia, all the companies that are in Russia, treat them all the same, maybe divest from them. But when we looked at it, being a fundamental credit manager, we see some pretty significant differences in different companies. So you have companies like Gazprom, which you could argue is and has been used in the past as an instrument of foreign policy. It's funding the war to some degree. There's close ties to Putin and all the key oligarchs. So from that perspective, it seems like a fairly straightforward question of whether or not it's good ESG. So we've downgraded it significantly on our ESG ratings. But then you have a company like Russian Railways. And Russian Railways has done a lot in years past to electrify the rail lines. They've gotten their emissions down considerably in the last few years. And in a country as big as Russia, if you're going to move freight across vast areas of land, it's probably the most environmentally friendly way to do it, much better than shipping it in trucks or on planes. So in the past, we've actually thought it was a good company. But it was a relatively good company. But there were reports that a lot of the war materials that made it to the front at the beginning of the war and potentially ongoing were moved using Russian railways. So we took their rating down considerably as a result of that, but it wasn't a clear-cut discussion. We really had to think about that one, and I think there's a degree of subjectivity in that assessment. And then it gets even more complicated. You look at a company like Eurochem, not state-controlled, but was controlled by one of the major Russian oligarchs. It does have a lot of Russian operations, but actually several years ago they moved their headquarters to Switzerland, so not actually based in Russia. And when the war erupted, the CEO of the company was sanctioned, and he proceeded to step down as CEO and withdrew his beneficial interest in the company, so he no longer controlled it. And the company itself is one of the world's major fertilizer producers, which is necessary for food, and we're already having a food crisis. So then the question gets a little bit harder of what you do in that situation. And so we were a little bit more lenient with that company. And then you have a lot of companies in Russia that just seem to have nothing to do with the war, and they're being sanctioned more because of their connections to the government. So you have a lot of leasing companies, for example, that are technically finance companies and potentially are being sanctioned just because of that and because they're state-owned. But again, you have to ask yourself, is that really the same as a Gazprom or a Russian railway moving troops and material to the front? So that's Russian companies. So it's already gotten pretty complicated. But then you have to look at the companies that aren't in Russia but continue to do business with Russia. So Yale University does some pretty nice statistics, and they're tracking most of the large companies that continue to operate in Russia or historically have, looking at about 1,000 or so. And they found that about 800 companies are either out of the country, or they've suspended their operations in the country, which means they may at some point go back, but at the moment they're not doing anything there. But there's another 330 that have only scaled back but continue to operate, and about 250 more that are basically operating as business as usual. So the question is, do we penalize those companies, right? Because they're not in Russia. We haven't drawn the fence around them, but do we have to start to bring them into the equation? But then you look at what some of these companies do, right? And it gets a little bit trickier. So you have Total, who has decided not to exit, for now, their joint ventures in Russia. And this is in contrast to companies like BP and Shell, who said they would do that. And to be fair, BP and Shell haven't actually exited. They've just ring-fenced it and written it off, right? But they haven't actually gotten rid of it yet. And Total's argument is, we could take away our interest in these companies, but then we'd basically be handing them over to the Russian government and to the Russian oligarchs for free. And is that really the right answer here? Or potentially you're going to have companies from India and China that come in and step into our shoes. And is that the right answer here? Is it going to make the companies less environmentally and socially friendly and just benefit other oligarchs in problematic countries? So that one, again, needs a bit of debating. But then it gets a little bit more complicated when you start to look at companies that do things that are a little bit more socially friendly. So you have companies like Philips, a Dutch company, and they're selling medical equipment. They're selling baby bottles, things like that. You have Danone, who's continuing to sell some food products in Russia. And their argument is the Russian people didn't start this war, and they need these products. And should we really be depriving them of these things? It's not like all of these things are luxuries, although in some cases there are some consumer good companies that are selling nice electronics, and sometimes it's the same companies. So again, really complicated. And then you can step back and say, well, that's companies, but there's still other countries that are impacted by this war. So we're here in Europe. The European Union continues to buy Russian gas, which is effectively funding Russia. They've put in place an oil embargo, but it's a pretty leaky oil embargo at the moment, and oil is a globally traded commodity, which is a problem. And then Europe is also going out and buying up loads of LNG on the spot market because they want to get off Russian gas without having to, have blackouts themselves. And that's driven up the price of LNG. And the buyers of that LNG were generally developing countries before, and now they can't afford it. So you have a lot of those countries that are in blackouts right now. I actually saw Pakistan had a long-term contract with Qatar. They weren't even buying their LNG on the spot market, but the price in the spot market was so high that Qatar was willing to default on that contract, pay the penalty, so they could start selling it on the spot market. And that's plunged Pakistan into blackouts that are having a pretty big toll on the country right now. And so then we see countries like India and China starting to buy Russian fossil fuels. And it's easy to point the finger at them and say, well, you shouldn't do that. But we're buying up all the fuels that they used to use and making them more expensive, and they don't have the same financial means sometimes as the European Union does to buy fuels. So when Russia offers them a 30% discount, it's sort of in their interest to take it. And it's not about supporting the war or not, it's more about what can they actually do. And then you see that there are effects that you completely didn't see connected to the war at all. So obviously Russia started the war, so there's some risks there. It's in Ukraine, so there's some risks there. But also Egypt is pretty heavily impacted. And why is Egypt impacted? Because Ukraine and Russia are really important for wheat exports and other food products that are being exported to the Middle East, including Egypt. right? And this has caused a spike in food prices around the world, which is hitting emerging markets particularly hard. And the last time that food prices were this high in the Middle East, we had the Arab Revolution, the Arab Spring rather, and in Egypt, I believe it was called the Bread Revolution. So the two seem to have a pretty clear linkage, maybe not complete causation, but definitely a linkage. So even though these countries had nothing to do with the conflict, didn't start the conflict, you can't say that the risks of the conflict are isolated only to Russia and Ukraine, right? Because there are ripple effects that go out everywhere. And it's really hard to draw a line of where those ripple effects start and end. So I guess the next question is, all right, so why do we care? And I don't have enough time, I don't think, to go into the difference in detail between ESG risk and ESG impact, but it's an important distinction to make, right? So it's often considered that if you're addressing the negative ESG impacts in your portfolio, you're probably also addressing the negative ESG risks and vice versa. But we're actually seeing that there's not 100% correlation. And the example with Egypt shows that. The impact was from Russia invading Ukraine, right? That was a negative impact. The risk is the food prices in Egypt. That's a risk. They're different things. They're not the same, right? And if you look at Total, there's potentially a risk there if they have to write off the assets eventually. Those assets, I think, are worth something like $3 or $4 billion. And as of the end of last quarter, I think the market cap of Total was about $140 billion. And as a debt investor, at least, you can look at that and say, okay, that's probably not going to cause them to default. They're not a high-levered company. They would be able to withstand that. So if we're divesting from Total, it's not because of risk. It would be because we think they're having a negative impact, which is a different thing. And similarly, if you're looking at impact, you might look at Eurochem, the example I gave earlier, and say, you know what, this is not having a negative impact to the degree that a lot of these other things are. I might be more willing to penalize some of the companies buying the Russian gas than I am penalizing Eurochem for just the fact that it has Russian connections, right? So you have to think about that more thoroughly as well, which kind of brings us to what to do about all this. And I think, especially when you're talking about emerging markets and sovereigns, there's a lot of data out there. And a lot of the models for sovereigns and corporates, too, like to pull in this data and generate a rating based on that. But it's all backwards looking. And oftentimes it's on a pretty big lag. And with a country like Russia, for instance, you're pulling in data on all sorts of themes, you know, literacy rates, healthcare, emissions per capita, all sorts of things. And so one individual factor only makes up so much of your final score if you're going with a purely quantitative approach. And there really isn't an indicator for started a major war on sovereign territory that wasn't yours. So you get to this problem that the backwards data is not going to capture the war at all. And if it starts to capture the war in some of the social metrics in the country, it's going to be on a 2 to 3 year lag. So you really need to be forwards looking, right? And when you try to devise rules that are based on simple quantitative metrics and black and white assumptions, then you're going to miss some important nuances, and you'll probably stay invested in Russia even as they're moving towards this war, and potentially even still if you were to stick to those rules without some sort of an override. So what we're learning is that it's important to have that qualitative overlay, and be able to play up factors that you think are underrepresented in the data, and have a good framework for how to do that. We're also seeing that there's a potential for opportunities here, and this gets back to the risk versus impact question. So I'm going to bring up tobacco quickly, even though the connection might not be obvious, but tobacco companies have a lot of negative ESG impacts. Pretty obvious. That has led to some ESG risks. But the companies have very healthy balance sheets a lot of the time, and they pay a spread that's much higher than other companies that have similar balance sheets. And some of that spread is to compensate you for the financial risks that you're taking, but a lot of the spread is excess premium you're getting because no one's going to buy tobacco companies because of their own reputational risk or because of their preferences on values, on impact, right? And so actually, if all you cared about was risk, you could actually get better risk-adjusted returns by buying some tobacco companies. So if you're, and I'm not saying you should buy tobacco companies if you care about ESG, I'm saying if you care about ESG impact, you shouldn't buy tobacco companies. If you care about risk, there might be a case to be made to buy some of them. And the same thing might come true with Russia. There might be some opportunities where everyone has sold off every Russian companies, and it's a little too early to say which ones they will be, but there might be some opportunities for security selection where you think the premium that you're getting is more than enough to compensate you for any Russian ESG risk. And actually, some of the early examples showed, unlike tobacco companies, which really just do the one thing, there are a mix of different companies in Russia, and it's possible that at some point we'll see that not only can you do something that's where you're getting extra risk-adjusted returns, but you might not actually be having that negative an impact as well. So if you're able to be flexible, if you're able to take a more nuanced approach to it, you might actually see a lot of opportunities. And I know I'm running low on time, and I think that there was some desire to go into Q&A. So I'll probably leave it there, but the key message, as I was saying before, ESG is complicated. It's important to take a nuanced approach, and it's really hard to just draw a black and white line around things. You need to look at the entire system, and you need to look at all the factors holistically. Okay.
Thank you, John. Well, you explained very well how complicated this is, but did you actually, what companies did you actually go out completely, if there are any?
It depends on the portfolio. And I think in some cases, you can't get out. Mm-hmm. So if you're trading at zero, it might not be the best time to get out. Uh-huh. In our ESG portfolios, for instance, I think Gazprom and Russian Rails and a few others fell below our impact thresholds, and so we were forced to get out within 90 days, which is a rule.
Mm-hmm. As an ESG fund, as an ESG.
Yes, so we have ESG funds, and they employ what we call ESG impact ratings at our company, which are purely about impact. We make the distinction between risk and impact again, mm-hmm. and those funds are designed for investors that want that impact angle in addition to the risk angle, which is incorporated in all of our credit ratings. And in those funds, we have thresholds that you can't invest in something that has an ESG impact rating below X.
I see.
In this case, it would have been 20, and these companies fell below that, so we had to get out.
But do they stay in the regular portfolios? Say the non-ESG portfolios?
Yeah.
Yes? Okay. Okay. I think there might be some questions here, because this is a topic that concerns us all. Where do we divest? What companies do we keep? What countries do we keep on? Are there any questions for John here? Yes?
Thank you, John. My name is Valeria Dinnerstein, and I work for Northern Trust Asset Management. I thought it was a very, very interesting presentation, a lot of nuance to where the ESG risks and impacts lie. I think I tend to agree with you that there is a big distinction there. And it's interesting to hear that you're actually incorporating ESG risks across the board, because they're, well, you know, is that, my assumption then is that you consider them to be financially material and impactful to the overall business of a corporate, whereas ESG impacts might not be. That's kind of me extrapolating what you're saying. So can you talk a little bit more about that? That's my first question. And my second question is, well, your presentation is called Beleggen in tijden van oorlog. So I'm assuming that, you know, what about after the war? You've kind of alluded to it a couple of times in your presentation. But so, you know, Russia leaves, no more war. Then what? Have you guys thought about what the next steps will be?
Sure. So I think you're right on the impact versus risk side of things. So when we say impact, it's whether or not it's financially material, and when we say risk, it's financially material. I use this example a lot to illustrate it, but I think the example, it's not related to Russia, but of COVID vaccines is really useful. So when the vaccines were first being rolled out, governments were rushing to stockpile them because there's not enough to go around. And some of the pharma companies were taking advantage of that to sell them at really high margins. And potentially these were the most profitable drugs they've ever sold. And then there were other companies that sold them basically at cost. And if you're looking at it from a credit perspective, you would actually prefer the companies that, all else equal, that are selling it at a high margin. That's better for the credit. You know, governments are the ones buying it. Governments aren't going to sanction them. Governments were trying to bend over basically backwards to get these vaccines. Whereas if you're looking at it from an impact perspective, you would prefer the company that's selling at cost, because that makes it more affordable. And you'll see in developing countries, they were usually buying those vaccines, right? So again, not always the same thing. And then the second question, what to do? So to be honest, no, I don't know the answer, and it depends a little bit on how the war unfolds and how long it takes and what the continued involvement of companies is. It's going to be a complicated question, but I don't have the answer to it yet, and it will probably depend on what actually happens.
But I assume that you already are discussing this. I mean, there's talk of this war going on for a long time, but it might also hopefully end very soon. Then you have to act again.
Yes, and I mean, it's a regular conversation, but more from the credit side of things. But I think it really is difficult to know what the world is going to look like, and you can game plan for 1,000 iterations and scenarios, but you'll probably miss the one that actually happens. So I just think it's too uncertain for me to know what to do in this situation. So it's something we talk about, but I don't think we have a clear answer yet. And I'm just being honest on that. I'm not sure who would.
Good. Do you get many questions of your clients? Because I would assume that, for instance, Dutch pension fund that is invested in Gazprom right now might get some nasty questions from their participants. Do you get a lot of questions from your clients about how you handle things, what you are invested in, and what your strategy is?
Oh, for sure. Yeah, so clients will come to us and say, we see these names in your portfolio, can you explain why? And we will explain why. But the questions all vary. But a lot of times they see the name, they know there's a story, and they want to know why we're holding it. And sometimes the reason we're holding it is, yes, there's a story there, but we think we're being more than compensated for the risk. In some cases now, for instance, is the question, the issue is more, well, if we sold it, we'd basically be selling it at zero. So we might as, if it's just about risk, we might as well hold on. Some clients have a preference that reputationally, they don't want to be involved in that. But there's also a difference between holding a position you already had, and if Gazprom came with a new issue and we bought their new bond, we would actually be financing new activity versus if we hold the old bond, which is already trading, not like at a depressed price, we're not really helping them in any way at that point, right? And if we sell it, it's not really going to change the equation for them. Okay. Which is one of the interesting things with debt in the first place is companies need to reissue debt. They're constantly refinancing. So every time they do, you can decide again, do I still think that this is the right company to hold or not? Versus equity, which is perpetual. And when you sell it, you're just selling it to someone else, but the same amount of equity still stays outstanding.
So if you want to get out, there's a logical moment to get out.
Yeah.
Yes, I understand. And this war, of course, is in Europe, but there's also been a lot of talk about how this might work out geopolitically. Other countries, I mean, the countries mentioned the most is China, of course. Maybe find opportunity to do things like Russia. I hope they won't, but are you having a new look at a country like China, for instance, and see where you are prepared if something like that happens there?
Yeah, I mean, we're looking at it more closely, I think, would be fair to say. We already had a skeptical view on China, and so I think that was something we were already considering. The situation is pretty different with them, though, I would argue. And again, we're not all political strategists, but it's something that we consider for sure. And I hope I'm not mistaken, but I believe we're currently a bit underweight on China. So,
okay.
But some of these things too, I mean, you can be out of a name completely. Some of these things you have to probability weight the chances of things happening, because if you get out of the name at the wrong time, too early, on a kind of gut reaction to something that's happened somewhere else that you've extrapolated without really doing the work, then you might actually be selling something you should have held on to. And so if there's a 90% chance that things are fine and 10% chance there's not, but when that 10% happens, it's a pretty bad result, you have to decide what to do. And so it's more one of those situations. And so in this case, we're sticking with 90%, so we haven't necessarily said no China.
Okay, so at least you gave us a very good insight in how complex war is from an investor's view, let alone, of course, for the people in Ukraine themselves. John, thank you very much.
Thank you.